Hello everyone, it's Dr. Marks, and our topic for today is economic profits and the connection to entry and exit. Now, in the model of perfect competition, we're going to be talking a lot about economic profit, and when we actually use the model of perfect competition, we need to understand the idea of entry and exit into and out of the industry, and specifically how we would show this graphically. So let's quickly review. In the first parts of this lecture, we discussed the difference between accounting profit and economic profit. At this point, you should understand both accounting profit and economic profit, and you should be able to calculate both. So if you're confused on this, please go back to previous homeworks and the previous lectures. You should also understand the condition of zero economic profit as our equilibrium condition. So we talked about the idea that zero economic profits is a point where no one wants to enter, nobody wants to exit, and it's a point of stability. So again, let's make sure you're clear because this is very important. At zero economic profit, no one wants to enter, nobody wants to exit because they can't do any better off than they are doing right now. So if nobody wants to enter and nobody wants to exit, we would call this a point of stability. It's a point of stability with respect to number of firms, and it's a point of stability with respect to any influences on price. If you have entry, that's going to drive price in one direction. If you have exit, it's going to drive price in another. But if nobody's entering and exiting, then you have a point of stability with price and, of course, number of firms. The idea of supranormal profits is important to understand because it leads to entry. So recall supranormal profits, you can kind of think of this as like being great profits. We're talking about economic profits being greater than zero. So when economic profits are greater than zero, this is going to lead firms to enter the industry. Remember, firms are entering because they can do better in this industry than their next best alternative. That's where we get zero economic profits being positive. Remember, if zero economic profits are positive, then your accounting profits are greater than your next best option. But if we have economic losses, where economic profits are less than zero, they're negative economic profits, then we have exit. And so we're going to see exit because firms can do better if they move out of their current industry and pursue their next best option. So again, make sure you're clear. Supranormal profits, where economic profits are greater than zero, leads to entry because firms can do better in this new industry. If firms have economic losses or economic profits less than zero, then firms are going to want to exit and move into another industry. So what we want to do is take a look at these two phenomena. And again, if you're not really clear on what it means to have economic profits greater or less than zero, I urge you to go back to the previous content. Remember that we're talking about long-run phenomena. So in the previous lecture, you learned that firms can really only enter in the short run, rather in the long run. They can't enter in the short run. So again, let me say that over. This is a long-run phenomenon. Firms cannot enter in the short run. They can only enter in the long run. So what does entry and exit really look like? Let's start with a firm in industry X that sees supernormal profits. So let's say industry X is just doing really well and firms are making supernormal profits. As we've already said, if firms are making supernormal profits, this is going to attract firms into this industry, right? They're looking around and saying, hey, companies that are in industry X seem to be doing really well, and maybe we should try to enter that market too. So we're going to see firms being attracted to the industry. Remember, when firms are attracted to the industry, this leads to entry. So as firms enter, we want to think about what will happen. So firms enter the industry, and think about it. When firms are entering, this is one of our ceteris paribus assumptions, right? The number of suppliers increases. So more firms increase in number of suppliers. So this is simply one of our ceteris paribus assumptions for supply. It's a supply shifter. So if it's a supply shifter, then obviously supply here is going to increase as number of suppliers increase. Well, we know how to graph this, right? If number of suppliers increases, which increases our supply, then obviously we're shifting our supply curve to the right. So take a look at the graph, and we already understand what to do here. Now, hopefully we understand that entry drives prices down and quantity up, right? Everyone agree with that? We just increase supply. So if we increase supply, price goes down, quantity goes up. And at the same time, there's more competition in the market, right? There's more firms here. So obviously, when you have more competition, this is kind of intuitive. More competition drives prices down. In areas where you see more competition, we see lower prices. Now, think about how this is going to impact supernormal economic profits that have existed in Industry X. Remember, we said to begin with that Industry X is making supernormal profits. The firms there are doing really, really well. And that's what attracted the entry to begin with. But now we have more competition. So hopefully, intuitively, you're understanding what's going to happen. Now remember, we just said entry results in a lower price. Can you tell me why we had that lower price? Well, it was from that supply increase. So if you're not clear, go look at the graph we just illustrated where supply shifted to the right. So entry results in a lower price, and there's more competition for market share. So if there's more competition for market share, then clearly we're driving economic profits down. So you're getting a lower price, more competition, and this is going to push those supernormal profits down. It's going to drive economic profits down. So hopefully you see what we've just concluded. Entry of new firms competes away the existing supernormal profits, right? The entry competes away those supernormal profits. So think about it, guys. Are the firms that were already in this industry happy about entry? Of course not. Entry has been bad for these firms. These firms had supernormal profits. Others entered the industry and they competed those supernormal profits away. If supernormal economic profits start to fall, then do you agree entry is going to start to slow down? So I want you to think about the process of how this happens. Do all firms enter at one time? No. So if supernormal profits are starting to fall, then maybe a few more firms enter, but at some point entry is going to start to slow down. There's just not as big of an incentive to enter this new industry, Industry X. Eventually, as firms continue to enter, but entry slows down, supernormal profits going to be competed away completely. It's important to understand that as long as there's supernormal profits to be made, firms are going to want to enter. But when we get to a certain point, entry will have competed all of those supernormal profits away. At this point, economic profits are going to fall to zero. So this is important to understand. We started with supernormal profits. Firms entered, maybe a few at a time. They competed away those supernormal profits. And now economic profits have been completely competed away. They're now equal to zero. Now remember what we said earlier. What we said earlier was that zero economic profits is a point of stability. Do you remember what's stable? Well, entry and exit. We don't see any more of that. Once we get to zero economic profits, no one wants to leave and nobody wants to enter. And price is going to become stable. If you don't have entry and exit, then price isn't being adjusted. So again, zero economic profits, no one wants to enter, and nobody wants to exit. And finally, if nobody's entering and exiting, the number of firms that we have in the industry will remain constant. So guys, hopefully you see that the idea of entry is a very simple story. So let's just look at it one more time. We had supernormal profits that attracted the attention of firms and other industries. They decide, hey, we might want to enter industry X. So one by one, kind of we start seeing firms enter, but every time somebody enters, it drives down price. Well, maybe not each one firm, but if you have, 3 or 4 or 5 firms entering at a time, it drives down price. And when price goes down, economic profits goes down. So the entry is competing away supernormal profits. And eventually they're going to fall all of the way to zero. And at zero, we have a point of stability. All right, let's move on. Let's think about how this might apply to Farm Bill. In my opinion, we've kind of seen this happen with the grocery industry and Farm Bill. Now, I'm not arguing that groceries and Farm Bill are a perfectly competitive industry, but we do see the same kind of pattern. A number of years ago, we had huge growth in Farm Bill. We had the hospital expand, we had a new business come in, and of course, Longwood University expanded. Well, this led to supernormal profits for the existing grocery stores. Remember, this is before any entry took place. So the firms that were already here, we had a Kroger, we had a Food Lion, and eventually we had a Walmart. And so those firms started making supernormal profits. Oh, I'm sorry, we didn't have a Walmart at that point. My bad, let me back up. We had a Food Lion and a Kroger, and I think we had a little Safeway, so pre-Food Lion, pre-Walmart. Sorry. So these supernormal profits led Super Walmart to enter the market. So again, don't mean to confuse you. We had a Kroger, we had a Food Lion, we had a little Safeway, but then Super Walmart says, hey, there's money to be made in Farm Bill. Let's build a Super Walmart. We used to have a Walmart, but it wasn't a Super Walmart. So that's why I'm getting myself confused. So we had a kind of a ring-ding old little small Walmart, and they decided, no, let's bring in a Super Walmart with a full-size grocery store. So as Super Walmart came in, it created more competition in the marketplace. Everyone agree, when Super Walmart enters a market, certainly there's more competition. Of course, prices fell. We know that Super Walmart entering puts a lot of downward pressure on prices, and so grocery prices fell. And of course, as grocery prices fall, the level of economic profits are going to decrease. And so entry caused there to be more competition and prices fell, and economic profits decreased. Now, right now, we're probably at the point of zero economic profits in the grocery store market in Farm Bill. And what that tells us, if we're at a point of zero economic profits, is that no one wants to enter right now. Nobody wants to enter. And it's unlikely that anyone will exit. Now, we have seen some exit. That little Safeway that I told you about, they couldn't really compete. They were too small. They didn't have economies of scale that allowed them to sell in bigger bulk or order in bigger bulk. They went out of business. But it's unlikely that what we have right now, that anyone's going to exit. So I think we're at a point of zero economic profit. But I want you to remember the difference between economic profits and accounting profits. So remember, stores with economic profits equaling zero still make accounting profits greater than zero. So again, does economic profits equal to zero mean you're broke? No. If we're trying to decide how much money Super Walmart's making, we need to look at accounting profits. Clearly, Super Walmart has some pretty big accounting profits. All we're saying is that they can't benefit themselves by packing up this store and relocating it somewhere else or taking all their energy and doing something else. Now, we're still seeing entry in the restaurant industry in Farm Bill. So given that we're seeing entry in the restaurant industry, maybe that tells us something here. For example, as I record this, there's a new restaurant that's supposed to be going in on 3rd Street. They seem to be taking their time. There's a Bergen and Bourbon restaurant that thinks it's moving to Main Street, but actually I just found out they think they're going to move one block off of Main Street. So wouldn't that be cool if there's a Burger and Bourbon restaurant? It's going to be something supposedly that would have a dance floor and be open late night. So we'll see. Somebody has purchased and will reopen the Huddle House. So maybe by the time you're watching this in the future, the Huddle House will have been reopened. But right now, as I'm recording this, Huddle House is closed, but it's been purchased, so it will reopen. And the one thing that I should probably also add that wasn't true when I wrote this lecture is that now we're getting a kind of a gourmet taco place on Main Street. All right, you get the idea. This suggests that there's still supernormal profits to chase in Farmville. So if restaurants are still entering, that suggests that there's supernormal profits in Farmville. And they're basically just chasing these supernormal profits. But think about entry. What do we know will happen with entry? Now, we just talked about situations where we had supernormal profits. But now let's look at the opposite case. We might see a situation where firms are making economic losses. So let's move on. Instead of supernormal profits, let's look at the case of firms that are making economic losses. Well, when firms are making economic losses, at that point, some firms may choose to exit. So economic losses lead to firms exiting the industry. Why would they exit? Well, if you have negative economic profits, that suggests that your opportunity cost is bigger than your accounting profits. In other words, you can do better in some other industry. So why put all your efforts into this industry if you can do better elsewhere? So think about what happens. In the case of exit, the number of suppliers is going to decrease. Well, what do we know about that number of suppliers decreasing? That's one of our ceteris paribus assumptions. And it's a supply shifter, right? So if the number of suppliers decreases, do I know how to draw that? Sure. It's going to be a supply decrease. So basically what we're saying is that exit from the industry is going to look like a supply decrease. So let's take a look at the graph on the right. We see the supply curve shifting to the left as firms exit. And we know what's going to happen. Look at price. Price is going up and quantities going down. So let's hold on to those points. Price is going up, quantities going down, but that's market quantity. All right. So you can probably think through the story. At this point, you get it. As firms exit, remember exit is a shift of the supply curve to the left. What did we just say? Prices will increase. So firms are exiting, prices increase. Think about why that would be. There's less competition, and when there's less competition, prices might creep back up a little bit. The firms that decide to stay are better off, right? I mean, there's some firms that maybe are making losses, but they say, you know what, let's just hold on a little bit longer. And if those firms can just hold on a little bit longer, they're going to be rewarded because as firms exit, prices go up a little bit. There's less competition. Those firms that decided to stay are going to be able to start doing better. Those firms that decided to stay are going to get a higher price. They have fewer firms to compete with, so this is definitely a win for them. Do you agree then that their losses will start to decrease? So they're making economic losses, but now price goes up and they have less competition than before, so the losses start to decrease. The losses start to shrink. Eventually, with exit, as more and more firms exit, these losses will eventually shrink to zero economic losses, right? To no economic losses. These firms that have been able to hang on are going to be rewarded by the fact that these economic losses are going to disappear. So that brings these firms back to zero economic profits. Well, remember what we know about zero economic profits. Again, it's a point of stability, right? So remember one thing, just to tie this all together. We've been making the assumption that our cost curves capture opportunity cost. Now, I admitted in class that that's a little bit of a hand-waving thing. So when we look at these cost curves on the right, what we're saying is that we can capture our marginal opportunity cost as part of our marginal cost curve and our our average opportunity cost in our average cost curves. You get the idea. So the bottom line, even though it's a little bit of hand-waving, is that marginal cost, average total cost, and average variable cost capture our opportunity costs. So when we say we've got economic losses, we can get that right from these cost curves. So we're actually graphing economic cost here. So when we find profit, since we're capturing economic cost, we're actually capturing economic profit. And so again, we have to understand there's a little hand waving here, but you understand where we're going. So let's quickly review. Hopefully by now you understand that accounting cost and economic cost are not the same thing, right? If we want to know how much your firm is literally making, we look at accounting costs because that's what we're going to use for your profitability. We're going to figure out, are you making money by looking at the level of your accounting costs. Economic costs are a little different, right? Economic costs, we factor in both the explicit costs, but also the implicit costs, the opportunity costs. Well, that means accounting profit and economic profit are not the same thing. Remember, if we want to know how much money did you make and your tax return has to be based on that, we're looking at accounting profit. When we're looking at decision making, should we enter, should we exit, we want to look at economic profits. For our class, we're going to look at economic profits. In Econ 217, economic profits are what are relevant to us. And again, why? Because we're applying this idea as we move into economic modeling of industries. And economic modeling is about decision making. Now, along the way, you need to understand the idea of supranormal profits. Remember, this is kind of when you're doing really, really well. So supranormal profits, we're doing better than our opportunity cost, but those can be competed away. And then we get the idea of zero economic profits. So if we have supernormal profits being competed away, they're going to get reduced to zero economic profits. Remember that zero economic profits doesn't mean a firm is broke. And I'm going to say that over and over and over again. Zero economic profits doesn't mean a firm is broke. For example, if I make $30,000 as a professor in economics and Hampton-Sydney offers me a job at their university for $30,000, I have zero economic profits. My accounting profits, let's say my $30,000 that I'm paid by Longwood, is exactly equal to my next best alternative. So that gives me zero economic profits. But am I broke? No, I've got accounting profits. I've got $30,000 in my pocket. So again, a firm making zero economic profits isn't broke. They actually have accounting profits that are greater than zero. And you absolutely have to understand these concepts. Also remember that zero economic profits is our equilibrium conditions as firms enter and exit. When we finally end up at zero economic profits, nobody wants to enter, nobody wants to exit. It's our point of stability. We're going to refer to that as our equilibrium. Let me know if you have any questions. We're going to be using this content in class as we go through models of perfect competition. So it's really important that you understand this. If you have any questions, of course, let me know.